$75 billion. This Friday, SpaceX goes public in the biggest IPO in human history. $135 per share, a $1.75 trillion valuation. And here's what nobody's telling you. This isn't just a stock launch. This is a wealth transfer event. SpaceX just did something Wall Street has never seen. No price range, no book building, no roadshow feedback. Elon Musk walked into Goldman Sachs and said, $135, take it or leave it. And you know what? They're taking it. Here's why this matters for your portfolio. When a company can dictate terms like this, when demand is so insane that underwriters surrender control, that's when you know retail investors are about to get squeezed. Or, this is the allocation opportunity of a lifetime. Let's talk numbers, because this is where it gets controversial. SpaceX reported $18.67 billion in revenue for 2025. Sounds impressive? It is. But they also lost $4.94 billion. That's right, a nearly $5 billion loss. At a $1.75 trillion valuation, that's a 93.7 times price-to-sales multiple. Let me put that in perspective. Tesla trades at 17 times, Palantir at 81 times, Rocket Lab at 118 times. Morningstar says SpaceX is worth $780 billion. That's 48% below the IPO price. So who's right? The market demanding this IPO? Or the analysts saying it's massively overvalued? Here's what the S1 filing reveals. Only one part of SpaceX is actually profitable: Starlink. The satellite internet business prints money. The rocket launch business? Break even at best. The Mars development program? Burning cash. The XAI merger? That's a cash incinerator. But here's the trade setup. SpaceX is leasing compute capacity to Anthropic, 325,000 NVIDIA GPUs worth, at $1.25 billion per month. That contract runs through May 2029. But there's a catch. Either party can cancel with 90 days notice after the first 3 months. So you're buying a company where one profitable segment subsidizes 3 money-losing ventures, with a massive AI revenue stream that could vanish on 90 days notice. Now here's the part that actually matters for your trading account. SpaceX reserved 30% of this IPO for retail investors. 30%. That's unprecedented. Most IPOs give retail maybe 5%, if you're lucky. Hedge funds and institutions get the rest. This means if you get an allocation through your broker, Fidelity, Schwab, E-Trade, whoever's participating, you're getting the same $135 price as the mega funds. No premium, no waiting for secondary market. That 5% set aside for employees and friends has no lockup restrictions. Insiders can sell immediately. Elon Musk himself has a 366-day lockup, but those friends and employees, they can dump day one. All right, let's talk trades. 3 scenarios. Bull case, IPO pops 40 to 50% day one, hits $180 to $200. Why? Because $75 billion of demand meets limited supply. Retail FOMO kicks in, and index funds have to buy on inclusion. You're trading momentum, not valuation. Base case opens at 140 to 150, consolidates between 120 and 160 for months. Institutional rebalancing, lockup expirations, earnings reality checks. This is the range trader's dream. Bear case, Morningstar's right. Valuation collapses to $780 billion implied. That's $80 per share, a 40% drop. Catalyst, first earnings miss. Anthropic contract cancellation, or Musk does something Muskish on X. My play? Wait for the dust to settle. Let the IPO pop happen, let the lockup sellers emerge, then enter on a pullback to the $100 to $110 zone. Risk-reward is infinitely better there.